Portions of the following program may be pre-recorded.
The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Good morning. Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings investments in your retirement here on the Max Out Savings Show. Our show is all about saving money and building up wealth and understanding the very complex world today. We try to take very complex topics, break them down for you so you can understand them. Our motto and our philosophy is to save aggressively and invest conservatively. That is the key to building up wealth over the long term. Save aggressively and invest conservatively. I was talking to some people. I had a young man called me up the other day and asking about saving money and stuff, and he relayed how hard it was to save money, and he knew people that had been pretty wealthy and lost it all in real estate or other things, and he wanted to sit there and understand how he could build up the wealth. And I really told him, we talk a lot about the 401k plan, and which it depends. Could be a 403b, 457. It depends on it's a qualified plan. In a typical 401k plan, if you put away 10% of the money, that they'll give you a 3% match. And one person was telling me they get 7%, but typically you get a certain match. They'll match 100% up to 4% or whatever. You should put away 10% into the company plan. And our show really isn't about 401k plans. We don't manage 401k plans at Max Out Savings Advisors. We manage retirement money, rollovers, trusts, things like that. But we always try to talk about this because it's so important. And what I explained to the young man is, look, you can put away, you should do at least 10%. He was doing quite a bit. He was doing the max, and put away at least 10%, plus you get a company match. Maybe it's 13, 14%, so you're saying 14%, plus you put a few things and a few other things. That will build up to your retirement long term, so you'll have a successful retirement. You'll have savings. You put the money in, and let's just use 10% because I think that's the minimum. So, but it's also easy for the math. You put in 10%. Let's say you're making $100,000. Let's say you're making $80,000. Let's say you're starting out. You're making $50,000. So you're putting away. You put in 10%. So you put in $5,000. You get back a $5,000 tax deduction on your taxes right away. So you get part of that money back based on your tax rate. Plus it grows for the next 25 years, 30 years tax-free, and then you have to take it out when you're done. But one of the good things about these 401k plans is, in this case we talked about, is you could also, let's say you want to speculate on something else. So you're putting away 10% over your lifetime in the plans plus company. You're going to have a good retirement. Well, you can go save money, invest in real estate, invest in other stocks, and do what you want. And if something goes bad over there, it doesn't wipe out your savings. This stuff is locked in Texas. It's actually protected from bankruptcy, and so you can save money, build up wealth, have a safe retirement, and at the same time you can come in and you can speculate on other things. And if your investments go wrong, They won't destroy your retirement. They won't destroy your savings, all your savings, and that's real important. And that's another kind of advantage is you have tax-free growth, but you also have bankruptcy protection and other things. It's not that you're going to go bankrupt, but this way you can spend the rest of the money you have available to you, and you don't have to worry about it. Whereas if you just put your savings in a bank account, the next thing you know, you're going to need money for something else, or you need money for a car, an investment. And all of a sudden, you pulled all your savings down, and you maybe put it in something you thought was a sure thing. It didn't work out, and then you don't have any savings. So these plans are kind of siloed, which is another advantage to the plan. It's not just tax deductions. It's not just tax-free growth. It's not just automatic payroll deductions, but it's also siloing your safest and most secure assets from bankruptcy or anything else, and then it gives you the freedom to invest and do where you want elsewhere. So again, but it's always a backup plan. And that's one of the key things. So things rarely work out like you think. I mean, some of the best investments we had, we made investments in, and we had to put more money in. It didn't look like it was working out, and then we made a fortune. But these plans gives you the flexibility to do some of those things that you wouldn't normally have, and you don't have to worry about betting your entire lifestyle and your retirement on any more that you shouldn't. That's why we say save aggressively and conservatively invest. You want to invest more aggressively somewhere else, go do it. But, for your safe assets, that's what the really big money, I always said it on the show, I don't know how many times, the really big money invest very conservatively. You go to River Oaks or something, they love to talk about, a Bitcoin or an oil well or some small tech stock or whatever they've made a bunch of money in. They're not telling you that they've got $10 million, $20 million worth of treasuries and bonds and things that are no fun to talk about. And so something to think about when it comes to saving and investment. We've got a lot to talk about in the show here today. As always, things are just incredibly changing. Really, it's a very, very interesting market. We're going to be discussing some of that. Some really, really fascinating things this week to go over and concerning as well. Look, it's 1 month away. President Trump is going to be President Trump again, and a couple thoughts on this. And I think this is a game changer. It's altering it. President Trump is coming into a situation where we're borrowing $1 trillion. The last trillion was 105 days, like a week ago, and the debt levels $36 trillion. If you look at it, we have more debt than China does anywhere in the world. The debt levels are truly extraordinary. The spending is out of control for 23, 24, and basically for the budget they've got right now at 7.5% deficits. So we're taking in $100,000 to spend in the government, and we're actually in tax revenue $100,000, and we're spending $107,500. Anybody that knows, over 3 years, that's 22.5%, more debt, and this is what that we're running into than we've spent, and so spending is completely out of control. Donald Trump knows this. If he comes in there, doesn't do anything, comes over tax cuts, he starts blowing and going with tax cuts. We're going to spend some money, but ramp up defense spending. The debt's going to take off. The dollar's going to collapse. Interest rates are going to go up, and we're going to be in a depression. It's as simple as that. And so, hey, maybe not right away, but that's where we're going. I mean, it's just utterly reckless, out of control spending. So he has a plan. So Donald Trump has a plan with the Doge Commission, with Elon Musk and Vivek Ramaswamy, two very, very, very bright people that have been very successful that say, hey, we have a problem. We have to straighten out government. It's just the spending is out of control. The defense, everything is out of control, and it's just crazy. One of the real concerns is defense spending. What we're spending on weapon systems is out of control. And by the way, it's not like, hey, we're spending all this money. We're spending $500 billion on this new, fighter weapon system, and it's like, no, we're spending $1 trillion on the fighter weapon system. We're designing it. It's going to come into start production in 2030, and then we'll start ramping up production by 2035 35. It's like 10 years till we even hit anything. It's just utterly crazy. And just an example, a friend of mine, they have a machine shop that does military grade, very high end machine. They can build parts and stuff. And well, it's not a big. It's a smaller operation. Well, the government comes up with all these new rules for the Defense Department, and they have to have quality control people and all this special quality. And they're like, look, we can't afford that. But so a bigger company that needs the parts goes, hey, look, we're going to send over our quality control people. They can kind of work part time for you and get and make sure everything's going. They go, okay, we can do that. Well, the government says no. We want each company to have special quality control people in there. So this company goes, look, hey, we're not doing it. We're not bidding on the contract. So when I thought we have 40% of our attack submarines today in repair, waiting for parts, and they don't have a worker. This is the reason why, because of these goofy rules that the bureaucracy has put in place that hey, sound real good, but really work, but delay contracts, make things too expensive, put at the deadlines. I talked to a rear admiral. I said, yes, sir. It seems like I don't understand why it's taking 5 years, to build the ship. And so he looks at me and goes, what are you talking about? It takes like 7 to 10 years. He said it's a complete disaster. And these people, there's a million ways we can save money and understand it. And the reason why this is important is that, again, we've got this out of control spending. Money is falling from the sky. I mean, the last 4 years is the biggest orgy of government spending since I don't know when. I mean, I think you probably have to go down to Roman times or something to really to get this type of utter insanity where you had an insane, like who was it, Nero or one of those guys, Caligula, where they just went utterly crazy. And basically now we realize Biden really was utterly crazy, but you've never seen this. I mean, it's just the money people are making. The wealthiest counties in the United States are all, I think 7 of the 10 or 6 or 7 of the 10 are around Washington, D.C. They don't produce a damn thing. It's not like, hey, they're in Hollywood, New York City, finance, Houston, Texas, for oil and gas, or something. They're in Washington, D.C. And it just shows you, if you want to get rich, the last 20 years, quite frankly, you go to Washington, you figure out a way to get something from the government, get a contract. And this has got to come to an end. If it doesn't, we're going to have a hyperinflation that's going to wipe out the country. And so Donald Trump is coming into that. And look, and we saw this yesterday. They come up with the spending bill. A stopgap spending bill. It's 1,500 pages of more spending. This is how we got there with these ridiculous programs. Is this out of control spending in Washington? And so finally, Trump and Elon Musk have to say, guys, look, hey, this bill's not going to cut it. And they finally, I think, got it from 1,500 pages to like 70 pages and got off all the stupid spending. But Congress just went right back to business as usual. We're borrowing $1 trillion $1 trillion. Go try to figure out what $1 trillion is. It's absolutely mind-boggling. We have 337 million people in the United States of America. That's a third of a billion people. Okay, there's 1,000 billion, and so what is that? That's like 3,000 times the population of the United States. These guys are spending every 100 days. The numbers, if you count, I forgot what it was. It's like thousands. It's just some absurd amount of time just to count to $1 trillion, and yet these clowns in Washington are blowing through money like no tomorrow. What we're looking at is out of control spending. So Elon Musk says something because he's on the Doge Commission. He's like, look, guys, I'm trying to control spending, and you guys are going crazy over here. There was finally some pushback, and we saw some congressmen, complaining that they're not going to permit spending. Well, look, guys, for this thing to work, all the Republicans have got to pull together. One of the more, if I were the Democrats, the Republicans, if I was Donald Trump, I would study exactly what Joe Biden did. I mean, candidly, the guy had one of the tightest, barely holding on to the House and the Senate, and he managed to get through one ridiculous thing after another. And the reason is because the Democrats all stuck together. The Republicans, they've got the... we're running out of time here. Tell you what, we got to take a quick break and be right back. We'll discuss some more stuff and what's happening to these markets. Why did we have the Dow down 11 days in a row for most 1974? We'll discuss that after this quick break right here in the Max Out Savings Show.
Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday at 7 a.m. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com. This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com. In the 1970s, the big song was the Bee Gees' Stayed Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
Welcome back to the Max Out Savings Show. So we're talking about we've got the Doge Commission coming. We got a mountain of debt. Where $34 trillion worth of debt. It's preliminary target to go to $40 trillion next year. They're going to struggle to try to get it done. And the first thing to do is the Republicans don't stick together, and they finally get a deal. And one thing you have to understand with these Rhino Republicans is that, I always thought the Rhino Republicans were, they were the moderates in the middle, Romney, those type of people. That the conservatives were all wanted this stuff over here, and then the moderates were really moderate. They were just what the moderate people. They were never what the middle of the road people wanted. What they were is, and quite frankly, you probably can kick Cornyn in with this group, and there's a whole bunch of these people in the middle. What they would do is they would come in. When the conservatives had a deal or something, they would come in and they would hold it up until they got what they wanted from big corporate, from Wall Street, from the drug industry, from the healthcare industry. All these people, they were operating in the middle. They were really more corporate senators, and senators in particularly, and some House members. They were corporate congressmen that were working in the center, and they were playing the Republicans and the Democrats off each other. But they didn't care about the working people in this country like the Republican Party did. Their main concern was could they get special carve-outs for Wall Street, for big banks, for drug companies, for the healthcare industry, all these other things. And people are fed up with it. I tell you, one of the scarier things is that CEO of the United Healthcare, they got killed. They did a study 40% of the people between age 18 and 29 didn't think it was bad that the CEO had been killed. That is a concerning thing because people are fed up with this type of stuff out there. That's a very concerning thing. And by the way, I'm not sure that was all. They try to paint that as all a bunch of communists on one side. That's stretching across party lines because people are fed up with this stuff. They want the United States of America run for the people of the United States, not countries around the world, not big corporations, because a lot of these corporations, if you look at the margins they're getting, they're gigantic right now. Margins actually went up during inflation, which is very unusual. That never happens in the past. Typically, when inflation strikes, corporate margins get hit because their costs rising. But what they're able to do is they're able to sit there and raise prices quicker because many of them have oligopoly or monopoly positions, particularly the tech sector. And if you look at the tech sector is really grossly overvalued on any stretch of the imagination. If you look at it, the Magnificent Seven, they were 99% of the earnings growth in the third quarter of 2024, which is just ridiculous. That means the other 493 stocks didn't have any earnings growth in that quarter. If you look at the margins, the Mag 7's at 23.5% margins. The rest of the S&P is at 9.3% margins. And this is coming from monopoly positions. Now I open up my MacBook Air and I've got to sit there and look at Apple News. I'm trying to figure out how to get that off. And it's Google. Google controls a huge amount of the search, and like 90% of the search. If you look at Facebook and Meta, it's the same type of thing. These are monopoly positions. Apple has a dominant position, and so all of these companies out there are being investigated by the government. And by the way, those antitrust things, they're not going away under Donald Trump. I mean, if you look at Facebook and Apple and Meta. If you look at Google, if you look at Amazon, yeah, sure, they waltzed in and gave Donald Trump $1 million for the inauguration, but that doesn't erase the fact that they did everything they could to try to sabotage the conservatives for the last 5 or 6 years, and so, but those things are remarkably expensive. If you put the top 10 stocks, I think it works out to be 37% of the whole S&P 500 are those stocks. These big mega cap stocks are valuations are well beyond what they should be in anything. They completely dominate the market. As we said, if you look at I've just got a whole bunch of statistics here. The market weight of the top 10 stocks is 37%. Okay, the last time we saw that was in 1929. This is a real issue, and if you look at these big capitalization stocks, the valuations of them are very, very high. Even if you go down to something like a Walmart. Walmart started the year at 11 times free cash flow. It's at 19 times free cash flow, 37 times earnings. If you look at if you look at Costco is at 50 times earnings. Some of these companies here, 53 times earnings for some of these big mega cap stocks. But underneath it, there's been a real drop. If you look at the Dow Jones, as we said, it dropped 11 days in a row, which is the most. It's not done that since 1974 here recently. As a matter of fact, the Dow was down 8 days in a row, and the Nasdaq hit a new high. And we're looking at, we actually have a hedge on the Nasdaq because I think the Nasdaq is grossly overvalued if you look at it based on everything else out there. If you look at, I noticed just Exxon's had the RSI relative strength to Exxon just recently has gone down to 20, which is very low. If you look at if you look at the oil sector in general, this is why Warren Buffett stepped up buying last couple of weeks on. He's ramping up the buying on Occidental because he sees the value in the energy sector. But it's not just energy; it's in the wood sector, it's in the building sector, it's in the materials sector. If you look at Dow Chemical has gone down tremendously in here. And so what is this telling us? I mean, if you look at this, Dow Chemical topped out at $58. It's under $40 today. A big drop here basically since the election. And what this is telegraphing is there's some type of slowdown happening out there. Textron's another one. They've had to shut down their Arctic Cat, which makes snowmobiles, plants, and they make snowmobiles and four-wheelers. That's down year to date. The companies that are up right now are the companies that are all selling to each other for AI back and forth, and are able to sit there and use their pressure to create opportunities like Costco. Costco comes in and gets good deal. Look, you want to know who's going to miss their earnings? Go to Costco and see whose products are suddenly appearing on the shelf at Costco. I promise you the company's going to miss earnings. That's what happened with Levi's. All of a sudden Levi's showed up, 3 or 4 weeks later, boom, earnings miss. It's just, but they're taking advantage of some of these things. They're pressuring, they're using their dominant market positions to pressure companies. But the real big mega cap stocks are doing extraordinarily well. And the problem. Now you say, "Hey Ted, we need to be in all those stocks." I said the problem is the more we look at this, these big mega cap stocks, we've done some work on it. The more we look at them, the more it looks like. It doesn't look like 1999, because 1999 you had a bunch of stocks at 100 PE multiples, little stocks all over the place. They were gone. But you didn't have these massive capitalization, monster capitalization, $3.5 trillion on Apple. I've got the new Apple phone. It's a piece of garbage. It's drop call. When it goes between the cell towers, it drops my voice. Their new upgrade is just overly complicated. I mean, I regret buying the thing, and yet they have this just absurd valuation on it. If you look at some of these other companies, again, we talked about Costco. Costco, 53 times earnings. They're growing at 14%. If you look at Walmart, 37 times earnings. They're growing at 7%. So it doesn't look like 1999 for these companies. It looks like 1929, where you have massive market cap stocks, a few massive stocks dominate, and as we said, the percentage wise was at the top 7 or 10. They came in. They're closer to 1920. That's the last time it was like this was 1929. The top 10 stocks were 37% of the market. They don't think they had the S&P. I think it was the Dow at the time. It dominated the averages. That's what it was. But if you look underneath it, if you look at the Nasdaq, if you look at the IWM, if you look at NYA, which is the New York Composite Index, that's under the 100-day moving average. It's dropping. The Russell 2000 is under the 50-day. Under the 100-day. So, these are kind of warning signs of potential problems. And so this is kind of what we're seeing out there right now is what's going on. But if we look at the S&P 500, it basically, which is mostly the big caps, capitalization, mega caps, that's right on the 50-day, and the Nasdaq is actually above it. And so you've got a look. I mean, you cannot have a lot of the industrial stocks selling off, and then have these big capitalization stocks keep going up. I mean, the Nasdaq is still well above the 50-day. It won't even go down at all. And I think we're coming into the year end, and particularly a lot of these tech stocks. As soon as the January 1st starts up, there's going to be a substantial sell-off because they can sell. They don't have to pay the taxes if they wait another 5 trading days. And so this is what I think we're looking at here on these markets overall. Is this is a very bifurcated market right now. I mean, if you look at the Dow Jones, as we said, the Dow Jones went down 8 days straight, and the Nasdaq hit a new high. Think about that. It wasn't just it was if you look at the NYA, which is a broad market thing, that dropped off as well. And if we go back and look at we say, well, look, Ted, it's coming back. Donald Trump's coming in power. This is all great. Interest rates, the Fed's been cutting rates. Interest rates are going. I've been hearing interest rates. The Fed is cutting rates since the beginning of the year, which started this whole market rally. And since then, if you look at it, the interest rates are up. From rates are actually up in 2024. They've gone higher, and that's what we're looking. So for this market has rallied on falling rates. Rates have dropped 75 basis points on the long end. The rest of the curve is up almost across the board. And interest rates for 2020 have gone from about 3.9% to 4.5%. Rates are going up. Our debt levels are going up. So we're burning through almost another $4 trillion worth of additional debt. The problem is with the market going up the way it is, and this is the key: the market's surging up. Big techs, everybody's pouring into Apple, Meta, Amazon, Walmart, Costco, all the big mega caps. The money's pouring in. Where is it? And these are gigantic mega cap stocks. Apple's got $3.4 billion. Where are the trillions? Where's the $4 trillion going to come from that's going to fund the budget deficit next year? Let me give you an example. If you look at the borrowing for 2023, Janet Yellen set borrowing we're borrowing about 8. I think the number is either 18 or 2 years. I think it's less than 18 months. The borrowing was 15% of all the federal borrowing was 18 months or less, short term. So when you borrow new money, you want to borrow longer term so you can manage your structure. She converted the 30% of borrowing was 18 months or less. And what she did is that forced the Fed to buy those treasuries to try to keep rates down because they want to control the short end, which is what they can do. And that, since she wasn't borrowing that extra 15% on the long end, which that kept the longer end rates down. That's gone. Now Trump has got to somehow balance all this. This is why mortgage rates are going up to 7% right now. This is why, if you look at the home building sector, home building is selling, has just fallen off a cliff in December because rates are going up. So Trump is having to deal with, they know what I just told you, and they're having to deal with. So he comes up with the Doge Commission to try to restructure things. In addition, he comes up. He's going to cut $2 trillion worth of spending. He's going to try to grow the economy, but that's going to be longer term. The key is he has to make sure this can work. But the problem is the Democrats are doing everything they can to sabotage him. I think there's rumors that they've signed contracts with federal employees that they don't have to come back to work till 2029. It's one thing. They're shoveling money to Ukrainians, to everybody out there to try to to spend as much money as possible. So Donald Trump comes in and the cupboard is going to be bare. And if the Republicans do not stick together, the interest rates are going to skyrocket. Inflation's going to continue because inflation's going up. The dollar's is going to be in trouble. It can collapse, and interest rates are going to go up. And you're going to see a substantial recession at best case in the United States, or worse, or you could see a hyperinflation. And this is what we're dealing with. And this is why I still think you want to be in these. You want to spread your assets out. You want to have your lending short term. You want to be in quality stocks. You want to be in extra cash, and you want to be in commodities. You want to be in real things that they can't. Remember, the Federal Reserve can't print oil and gas. They can't print gold, and they can't print silver as well. And that's how you should protect your retirement. We'll be right back right here on the Max Out Savings Show.
Savings and investment questions? Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
Hey everybody, Charlie Kirk here. Ted Gioka, the founder of Max Out Savings Advisors, always says, save aggressively and invest conservatively. He specializes in helping people grow their retirement account with as little risks as possible. Ted combines working knowledge with the intuition gained from over 25 years of experience of value investing in the stock and bond markets for retirement accounts. Like you, Ted is deeply conservative in life and in his investment approach. His risk strategy allows him to anticipate market downswings to protect your money. Ted is also the conservative host of the Max Out Savings Show. You can listen to him every Saturday morning at 10 a.m. right here on The Answer. If the idea of saving aggressively and investing conservatively appeals to you, the best way to get to know Ted is to call him. The number is 713-627-0400 or visit maxoutsavings.com. That is maxoutsavings.com. Call Ted right now, 713-627-0400 or visit maxoutsavings.com.
If you can snap your fingers, you can find this radio station. So the next time you want to listen to us, your smartphone is now your smart radio. We're always on. This is AM 1070, The Answer.
And now, more of the Max Out Savings Show with Ted Gioka.
Welcome back to the Max Out Savings Show. As we're talking about the concentration of risk.
Ted, you have Charles on the line.
Okay, good. Hold the phone just a second, Charles. The concentration in these markets is really, I mean, we haven't seen this. It's bigger than it was in 1966 with the Nifty 50 and 19. It really goes back to 1929, which back then, I don't know if you had the electrification and the automobiles. It's kind of like the AI and stuff right now. It's the same thing. It's led to an over-concentration and over-valuation in these growth stocks, in these stocks with these multi-trillion-dollar valuations. Keep in mind, our economy is about $24 trillion in total sales, and Apple is $3.5 trillion market cap, and so these are just gigantic valuation numbers that I think really highlight a huge difference. If you look underneath it, you can purchase, different types of commodity companies, different types of industrial companies at just ridiculously cheap levels, because everybody is chasing, the hot stock, AI, quantum computing, and everything else. And if you look at the valuation basis, the outperformance of the United States market, it's typically, it goes between underperforming the international markets by about 0.8 to overperforming at maybe 1.5, 1.4, once in a while, maybe 1.5. It's at 3.5, which is utterly off the charts outperformance on any stretch of valuation. Any way you look at this, it's extraordinarily overvaluation. And so I think the prudent thing to do is spread your risk in some of those things. And I think for 2025, we're going to be starting to look more to overseas markets, because there's a good chance that this Trump revolution is going to spread to Europe and other parts of the world. It's already in Italy. It's coming. It's in Argentina. It's going to move other way as they get rid of these globalists and these New World Order people that have been choking out economies and destroying people's livelihoods around the world. Tell you what, let's take a call from Charles. Charles, welcome to the Max Out Savings.
Good morning, Ted. Just offer a comment or two and maybe a question to go with it. Your comments on the, I guess, the rhinos, so to speak, the Lisa Murkowski's, the Susan Collins, and the Cornyn's, and all these people. You know, my sentiment has always been that the buck stops with the voter. And if these people are in there, it's because the voters seem to like what they do. And until that really changes, you know, unless Republicans start a knock-on-the-door campaign now for the midterm elections coming up, it's going to be really difficult, I think, after watching what took place in the last couple of days here, for Trump to get some of these things done. I wanted to get your take on, and it's my thoughts, that I think that the SALT, the state and local tax deduction, I don't know how much revenue, when that thing was rescinded, how much revenue was lost on that. I know states like New York and New Jersey, I mean, obviously the heavily taxed states, they really want that back. But it seems to me that based on what I've been seeing, I would think that's probably going to happen. That's probably going to show up again. And the problem is, of course, as you pointed out, the debt level being such, you know, you got to fund it some kind of way. You got to be able to, you know, fund this debt. So what are your thoughts on the SALT thing to begin with? Because it seems to me that Democrats are really going to be pushing that.
Oh, look, I think they're going to do something. Right now it's $10,000, I believe. They want to move it to $20,000. I think they move it to $15,000 or $20,000 because these people in the Northeast, I mean, they're getting just destroyed by these taxes up there, and they need to probably do something to help them out. And I think it could also, you want to try to solidify some more congressional seats in those areas, and that's a good way to do it. So I think something's going to happen there. As far as these rhinos, look, I mean, one of the good things that's happened was Joni Ernst came out against Pete Hegseth, and there was just an avalanche of criticism, which I think was shocking to these people. And she backed it down. She said, "Well, no, I'm just insisting that he goes through the process. I wasn't against him at all, you know." And I think there's enormous pushback because a couple things. As I said, these corporate people in the middle have been trading off favors to corporations under the guise of we're helping out the middle, and they haven't been. And the Trump people are all wise to these people. The Trump didn't fail last time in getting stuff done. It was Congress that went and stepped in. And I think the quote they actually used was the adults in the room. And we didn't get a lot of stuff done because of it. And everybody is wise to their tactics now. And so those rhinos are going to be under huge pressure. They're either going to conform or they're going to be out, I think. I mean, there'll maybe be a couple in some states that they don't think they can get someone else in there. But for a lot of these other people, like Joni Ernst in Iowa, she'll get primaried out. And so I think everybody understands the situation now. And the one good thing is, as you point out, they have to find some way to pay for these things. And one of the spending. It's not just out of control spending, but it's rules and regulations. They have got to get all this stuff under control so they can somehow build out a military on a capital efficient, time efficient way. Which right now we're bogged down in. We're heading fast into. If we fight a war, we're going to lose the war. Yeah. Unless we've got some incredible technology that I don't know about. And by the way, we're not going to lose it because of our military, because of the will of the people. We're going to lose it because we have an industrial complex that is basically a slow-moving bureaucratic mess that can't get things out the door.
What are your thoughts on this? Because I've heard that what some people are saying is that this next once President Trump assumes power, that really the tax and the border should be combined as one bill to vote on. Because if they address the border first and not the tax, what's going to happen is the tax is just going to eventually just fall by the wayside. Do you think that should be consolidated, or do you think that they ought to take that separately?
I don't know the answer to that. I mean, that's a complicated answer. But I will tell you this. I think one of the things that's going to be paramount is that DOGE Commission has to be moved very quickly to start with big cuts. And what you want is you want to give the American people and investors around the world the idea that, hey, we are very serious and we are genuinely going to cut spending. If we do that, that takes a lot of pressure off of getting tax cuts through, because you can say, look, we're cutting all this stuff here, and here. So this DOGE Commission, and this, by the way, this is why Elon Musk stepped in when he did, because he sees that these guys are trying to, they're trying to sneak through a bunch of spending at the last minute, and you got to shut it down. We've got to come up and go, guys, look, China, Saudi, Arab countries, Japan, people around the rest of the world, the United States, we're not going to let our deficit spiral out of control. We're very serious. Look what we've done. And so I expect to see something in the first 60 days to do that. That's going to be, in my mind, critical. If you can get that program through and push where people believe something's happening, then that gives you the flexibility to cut taxes and make other changes without the dollar collapsing or interest rates jumping up and just causing a huge issue.
Well, one last thought, Ted. The midterm elections, to me, it almost seems paramount to do what basically they're wanting to do. You almost got to have a 60-man majority here, and with basically one person majority in the House, this is going to be almost, if not impossible, next to impossible, because that's why the elections in 2 years are going to be very, very important if they're committed on that.
I agree. Here's the problem: we don't have 2 years. These guys got to do something right now. I mean, $1 trillion. Yeah, by then it'll be $44 trillion, and at some point in time, the dollar's going to start collapsing. Look, at the beginning, when we started 2024. Everybody thought rates were going down lower. The Fed was going to be cutting rates. The Fed only cut 75 basis points, and the long end went up. Okay, so remember what I said about the 30% short-term borrowing when it's normally 15. That's going to have to be shifted out longer term, which is going to put further pressure on long-term rates. It is paramount that we show that we are very serious about restructuring the United States government to maintain that confidence is sort of there. But if it looks like it's all going to fail, the confidence will fail, the dollar will collapse, and interest rates will go up, and the markets will plunge. And so that's going to be the key point.
Then you're into Bitcoin and gold.
Yeah. Thanks, Charles.
All right, thank you.
I mean, I still like the Bitcoin to go. I think oil and gas I think is a great place to be right now. Warren Buffett stepped up to the plate this week, was buying. If you look at some of the commodities, the oil and gas is about even. If you look at the agricultural commodities, they're down 15-20% pretty much across the board. Natural gas is down about 13%. So. But of course, the big winner was chocolate or cocoa for this year in Bitcoin. But and gold is up. Gold is up 21, 22% as well. But I still like, silver is up a little less, which is, by the way, that almost never happens. I think silver is going to be a very good place to be for 2025. I saw a statistic that I think Elon Musk said that if you can get 100 by 100 block of 100 mile by 100 mile block of solar panels, you could power the United States effectively, or something along those lines. That takes 5 years of silver production just to do that, and so I think they've been kind of keeping silver down. We like the silver stocks in general. I'm actually some some of our gold stocks did very well. A couple of them didn't. Some of the bigger ones did not do well. I think that's going to change. Gold had a very good year, but just a lot of the commodity stocks are down, the oil stocks are down, the industrial stocks. If you look at those groups of stocks we've been talking about, everything from Weyerhaeuser to Dow to Textron, you would think, oh my God, they're signaling a recession's coming. Now they're looking at China and some other stuff. I think we're going to kind of muddle through this. I think that stuff is probably over. So I think it's about 3 minutes. Okay, the real risk, I think, is really these big cap stocks. And I know I've been saying that, but these big cap tech stocks, they still have to do something about the antitrust. The valuations, as we said, are just gigantic. And I think for 2025, international stocks, I think, have some real opportunities. We're going to see some Germany has single-handedly destroyed themselves. You're going to see countries start to turning around, and I think that's going to be another opportunity. So I think it's still going to be commodities, international stocks, short-term bonds still. You want it in high-quality bonds. And I tell you, the other thing we're starting to buy more is very high or higher quality bond that we think can withstand a lot. As we go a little further out, we're buying higher quality corporate bonds, very high quality corporate bonds that we think could withstand a bigger problems that might be better than the treasuries. This is something to think about. We're doing a lot of research on that. We're going to be right on that. But I think for really, we want to, if you're going to be short to mid range, I would go higher quality corporates than governments, because I think there's a better safety factor. We're going to build upon that more. But a couple things. We're going to be writing about this. I've got the report written right now, and we've just been so busy. We're going to get that out. It's a free Max Out Savings report. All you have to do is go to our website, maxoutsavings.com, to pick it up. Look, we've written about everything from failures of investment banks in 2008. We wrote it about in 2007, pointed out. When COVID came in January, we were warning you about the dangers of that. It's the same. When the Ukraine war struck, we said this was going to be inflationary. We have brought one good thing after another ahead of everyone else in that report. We're going to try to continue to do it. It's a free report called the Max Out Savings Report. Just go to our website, maxoutsavings.com. If you need some help with your retirement, we hold assets. We're a manager. We hold our assets. Paul Schwab is our value investing approach. Go to maxoutsavings.com to request an appointment. We'll see you next week in the Max Out Savings Show. Remember that motto and philosophy, which is to save aggressively, invest conservatively. Thanks a lot.
The Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.